On this episode, we discuss today's lending environment.
Welcome to the Investment Opportunity Podcast. We'll educate you on the latest investment trends happening in one of the hottest real estate classes, skilled nursing and seniors housing. We'll point out the risks so you can reap the rewards of investing in this growing and complex industry. And now your hosts, Ben Boland and Brandon Boland.
Welcome to episode 9 of the Investment Opportunity Podcast presented by Senwell Senior Investment Advisors. We are your host. I am Brandon Boland, sitting beside my twin brother and business partner, Ben Boland. And we are again presented by Senwell, which is a skilled nursing and seniors housing mergers and acquisitions advisory firm. With us on the show today, we are very excited to have Neil Gamss with Housing and Healthcare Finance, and Neil is the Senior Vice President at HHC. HHC Finance is a leading HUD lender with experience and expertise to efficiently underwrite HUD-insured mortgage loans for a wide range of properties. These include multifamily housing, skilled nursing, assisted living, seniors housing, psychiatric hospitals, board and care, and acute care hospitals. And in addition to all of those things, in addition to HUD lending, Neil specifically is also the co-lead of the capital advisory group that specializes in placing bridge, mezz, preferred equity, and working capital loans with lenders and clients across the country. Since co-founding the group 4 years ago, they have closed over $2.5 billion in arranged loans. In other words, I'm going to say a dad joke. Neil, are you ready?
I'm ready.
Neil's doing deals.
Love
Great.
it.
Put that on your signature.
Better than I thought it would be.
Neil's,
Put that on your email signature.
Yeah. It's going up.
Neil, welcome to the show. We're actually very excited to have you. You are our first guest to speak specifically on the debt side of things, and we're excited to bring your valuable content to the show today.
Okay, yeah. Thank you so much for having me. And that was a heck of an intro. Thank you. A lot of information that you provided. But those are the services that we provide at HHC, and that's what we're involved in. I know that you mentioned, multifamily. I am more involved on the healthcare side. We have a specialized team for multifamily on the HUD side. So if anybody wants to reach out, I can certainly connect them with the appropriate people. But I think today we're going to be talking about healthcare.
Yeah, absolutely. Yeah. And I know that you're also attending, or you have I don't know if we can use that as a present term these days, but you have attended a lot of the conferences we've been to as well. So I'm assuming if people are attending NIC or some of the other conferences, they can see you around at those as well.
Yeah, as soon as those come back, I don't know when that's going to be, but I was at the last NIC. I think we saw each other there, perhaps.
We did.
And I don't know if that's where I got COVID, but I shortly got COVID shortly thereafter. So I don't know where it was, maybe on the plane on the way home.
Wow. Yeah, we've actually heard a lot of people that have come down with COVID, including myself after that trip as well. So I don't know if it was California or what it was, something in the air out there.
Yeah. Okay. Well, I'm glad. It looks like you're feeling well, so I'm glad that you are.
You too.
Yeah, Neil's also doing deals, but he's also looking good. Hey, Neil. So today's lending environment is actually, it's obviously a little bit different than what it was 6 months ago. So what are some of the specific things that you're looking at now compared to then?
So what's interesting is that the lending environment is different than it was 6 months ago, but it's also different than it was 2 months ago. So what we saw 6 months ago was, things were going great. Lenders were lending. We were very busy both on the capital advisory side with new transactions, with refinances, but also busy on the HUD side with, general HUD refinances. Then obviously COVID happened. I think it took, I don't know if you guys experienced this as well on your side of things, but I think it took, I would say about 2 months for everyone, both on the client side and on the bank side, to kind of figure out like what's happening over here. How do we deal with this? Obviously, many of the deals that we were working on, new acquisitions were put on hold right away, which makes sense because, most of my clients own portfolios outside of their new deals, and they needed to figure out, how to manage the crisis that they were going through. And at the same time, lenders also, I don't think that lenders officially said pause. because we were closing deals throughout that crisis in March and April and in May, but the majority of those deals were well on their way before COVID happened. And obviously, COVID really didn't disrupt the operations in those particular deals. And a lot of lenders kind of said, let's see where things fall out. Let's see how things, let's see what happens. But, thank God, what I would say is that, the government really stepped up for our operators. I don't know if you're saying the same thing, but they really helped them out with very, very necessary stimulus and PPP money for those that were eligible for it. And I think that obviously they're in the census building stage now for the facility. Everybody had a census, everybody's census is hurting. I would say regardless of where you are, but people are building back now. I'm hearing from my clients, and lenders are certainly back to not to where they were before, but they're back to lending money, put it that way. They're not paused anymore. That's for sure. There are different things to look at, obviously, now when you're underwriting a deal. And we help the underwriting both on the HUD side, but even on the bridge to HUD side. Obviously, we do our own underwriting before we're going to present to a lender. And, number of COVID cases and COVID precautions and stuff like that are certainly important for lenders to look at. And we're looking at them as well. But we're happy to see that many lenders are sending term sheets. We're signing up deals. Thank God, I would say over the past month.
So new originated deals you're seeing in the past 30 days, let's say.
Definitely.
Okay. And
there are fewer,
Go ahead.
There are fewer, I think people were expecting these major distress deals to happen and people to be selling out of desperation or bankruptcy or whatever you're calling it. We're not really seeing that yet. We're seeing that obviously operators, like I said, it took a census hit, but they have enough to keep them going, and they're seeing that improvement, that was the intention of those programs.
Yeah, and so let me, I guess, drill down more into the origination side. So as you start to look at underwriting new deals, what are some of the things that the lenders are requiring when you're underwriting today that they may not have required? Are they looking at, for example, a semi-private skilled nursing facility as a higher risk asset than a private room facility, for example?
That's a very good point. So HUD, it's funny, HUD was always very sensitive about that. They don't like facilities, skilled nursing facilities in particular, that have triple and quad ward type rooms. HUD never loved that. Obviously, we do those deals. But if the whole facility was filled with four-bedded rooms, HUD would pause for a second on that. And we're seeing lenders bring it up. I wouldn't say that lenders are saying, no, we're not going to be doing facilities that have double occupancy or triple occupancy. I think that they're going to be more concerned about what are your infectious disease control, what's in place. You have somebody that's in charge of controlling the spread of diseases rather than just saying no to those types of facilities.
Got it.
Now, other things that lenders are more focused on now, for sure, is obviously they're only going to be lending in this environment to a more experienced operator that's seasoned, that's been around. The first time guy that's buying his first building will likely have to partner with somebody else who has more experience in order to get that deal done.
And what about rates? So the seasoned veteran that's been with the same lender for years, have the rates changed with that same person, or even somebody that you said might have to partner with somebody else? Are you considering it with a higher rate?
So it's funny, HUD rates are actually at their all-time low right now. And bridge rates, which are very often floating off of LIBOR, LIBOR is very, very low now. Spreads have increased a little bit, the spreads over LIBOR, but not really. When you're adding the, LIBOR to the spread, it's kind of where it was pre-COVID at this point. We're not seeing lenders pricing in that risk. What we're seeing more of is if a lender deems this as a very risky deal for whatever reason, either because the building has very low occupancy or because they don't feel the operator is experienced enough, they just won't do the deal rather than pricing another 25 basis points in there.
Right, which is no change from what it was before, right?
Right.
So you've mentioned HUD a lot. Let's talk about maybe non-recourse loans. I know that was a big selling point pre-COVID. Are you seeing more loans come down as having some level of recourse assigned to them?
So obviously on the HUD side, that hasn't changed. HUD loans are non-recourse and they're still non-recourse. Right. That hasn't changed. On the bridge side, we are seeing the changes that we're seeing are not on pricing. We're seeing certain lenders requiring more recourse because risk has gone up. They want, their borrowers to be standing behind those loans. And we're also seeing, in some situations, leverage going down a little bit. They want to see a little bit more skin in the game. But it hasn't been so significant on the leverage side, I would say. On the recourse side, I think that to get a non-recourse bridge loan in this environment is possible, but challenging.
So walk us through an example. So if I'm buying a $10 million building, what did that look like 3 months ago, and what does that look like going forward? Again, assume I'm a seasoned veteran. I have all of the same relationships. What does that look like from a leverage and recourse perspective?
So the first question I would ask you, let's say you were a client calling me, you have a $10 million deal, you're an experienced guy. So the question is, what are you more sensitive to? Are you more sensitive to pricing, or are you more sensitive to recourse? That's the first question. Because if you're doing a bank deal now with a depository bank, that's most likely, with certain exceptions, most likely going to be between 50% and 100% recourse. So if you're someone who doesn't want to sign 100% recourse or 75% recourse, you're probably not going to be doing a bank deal. Now, bank deals are have the cheapest pricing. So we're closing a deal, God willing, actually today, with very aggressive pricing at regular 80% leverage. But if you would tell me, hey, Neil, I'm not going to sign 100% recourse on a deal right now in this environment, I'm too nervous. So we likely would go to a FinCo instead of a bank. Now, what's the irony is that FinCos provide more leverage than banks do. So, FinCos right now are providing leverage anywhere between 80% and 90%. So for our example, let's say 85%, you'll get 85% leverage, and your pricing will be anywhere between, let's say, 4.25 over LIBOR to 6 over LIBOR, whereas bank pricing would be anywhere between 3 over LIBOR and 4 over LIBOR. So you're definitely paying for that extra leverage and the reduced recourse.
So you talked a little bit about, you're really not seeing some of the risk assigned into some of these loans yet. Do you see that actually adjusting as we go forward, or is this kind of a short-term benefit that some investors can take advantage in this little short window, or will that be changing going forward? What are you seeing?
So just to be clear, what we're not seeing is pricing changing really. We are seeing risk becoming a factor because, yes, recourse is higher than it was before, and also leverage might be slightly lower. The same lender that was giving you 90% loan to cost might now only feel comfortable giving you 85% loan to cost, or 85 to 80, that type of thing. Going forward, I don't know if I see that 25 to 50 basis point spread increase so much, just because maybe the spread will increase, but LIBOR is so low that your all-in rate's going to be the same, I think, for the deals that get done and for the deals that lenders are interested in.
I also think that a lot of the operators are doing a phenomenal job of mitigating a lot of the risks that they're seeing on the front lines right now. Unfortunately, we're seeing a lot of stories out there, and it's just constant negativity. But that's just what you see on the 6:30 national news. But I think if you dig down and call up these operators and talk to the CEOs of what they're actually doing on the front lines, and I'm sure once you dig in and start doing some of the underwriting, you're seeing a lot of these operators really mitigate from a safety perspective their facilities.
Well, I'm looking at the financial statements and I'm seeing a lot of money being spent on PPE, which is good. Yeah. That's a good thing, and we can underwrite to that and we can add that back, and it's a one-time expense, but I feel very comfortable that it's there, Right. And I'm glad that you brought that up as well, because I speak to a lot of lenders, and lenders would be, nervous in this situation because they have a lot of money out on these portfolios, and if they would send something wrong, they'd be very, very nervous about it. And a lot of the lenders that I've been speaking to over the past 2, 3, 4 weeks are very, very, very complimentary of their clients and their operators. That they were presented with a crazy problem that hasn't come up, in the past 100 years, and they felt that for the most part they dealt with it really, really well. And similar to what you're saying, that on the news it's easy to sensationalize and to bring things up and to point fingers, but for the most part they were presented with a crazy issue that the vast, vast, vast majority of my clients dealt with really, really well.
Yeah, and I think a lot of the untold story actually comes down to the state associations, because you've taken, essentially you and your competitor right next door used to kind of battle it out and try to fight for occupancy. We're seeing a lot of those scenarios where the association is bringing everyone together, and that doesn't really matter what state you're in. I think most of the state associations are doing a phenomenal job of bringing everyone together and saying, hey, these are best practices, and we need to learn from these, 5 operators who are doing things right. And those operators are going out and teaching all of their other competitors best practices and safety measures going forward. And I think that has a lot of value, and it should hold a lot of value and somewhat de-risk, these lenders and some of these loans as well.
That's interesting. I didn't have that perspective from the association level. It's something that I definitely will bring up with my clients because I'm curious to hear that. But I am seeing collaboration and, people helping each other, really. And whether it was when it was difficult to get PPE, now it's much easier to get PPE. But in general, we saw a lot of our clients just being available for one another, even though, like you said, normally they're competitors.
Yeah, and that does remind me of another point. We're working with several states who have done a great job in working with their state in asking for increases in Medicaid reimbursement. And I think a lot of states are doing a great job, and we're seeing some of these stipends roll across state by state. How are you guys looking at some of these benefits? Are you kind of treating these as a wash in some cases, or are you looking at it as de-risking some of the portfolio? Because I think in some cases it's a short-term thing, or it's an unknown how long they're going to be receiving some of these stipends.
It's kind of like UPL in some states. You're
Yeah.
not sure how long it's going to last.
That's right.
You'll take it while you can.
Exactly. Yeah. So the approach that we're taking, there's really 2 different approaches to take. So, you're looking at a T12 P&L, right? So through February or March, for the most part, people were fine. And then obviously people took a dip in April, May, June in occupancy and increased expenses. So really, there's 2 ways to look at it. Either you could include those extra stimulus money and the extra rate increase that some states gave, which was great and helped operators tremendously. And those months then look fine. The way that the case that I would make is, if you're going to penalize somebody for their increased costs and their decreased occupancy, then you should also give them credit for the stimulus that came to mitigate those issues. You know what I mean?
You're going to get a lot of phone calls. You're going to get a lot of phone calls, Neil, giving them credit for that.
The other thing to do is really add everything back, kind of, whether it's adding the increased costs back and adding that additional revenue back. And the other case to be made, and this really depends on which state you're in, but for example, there are certain states on the East Coast and not Southeast, because right now Southeast, unfortunately, it's being hit pretty hard. But somewhere on the East, it's not South. We have operators that are already building their census back at this point. So the case would be made just don't include, April, May, and June in your T12. You could have a T12 through March, and then let's resume July, August, assuming occupancy is back to a relatively normal place. That would be the other option over there.
Yeah, and then on top of that, though, you have the media right now that's not painting the best light for the industry. So what's to say that could cause a decreased demand, even on the need side, on the skilled side? People could be shifting more towards a home healthcare model. How are you looking at that moving forward in terms of future demand and how that's going to affect?
So people haven't really brought that up. And when I say people, I mean lenders who I'm in touch with. There were some lenders that were like, oh, hey, on the private pay AL side, purely private pay, high-end AL, is there going to be demand for that going forward? Either because if there's an economic downturn, people can't afford that, or if just in general, I don't feel comfortable putting my loved one in a facility. I'd rather just keep them at home. That's a point to be made. But on the skill side, people are pretty bullish on skilled demand going forward. I think that we've learned that home healthcare, people were talking about this. I remember it was like 4 years ago. People were like, oh my God, home healthcare is going to kill the skilled nursing space. It didn't. and perhaps home health care could be a little bit of a replacement, in the beginning of the aging process when they're a little bit, going to need a little bit of help. But for a real acute care facility, which is what we're seeing our clients providing these days, the level of care and the level of acuity that they're dealing with is higher than it's ever been. We don't see that going away. I mean, personally.
Yeah. What about?
I don't know if you feel the same way. Do you feel
I
differently
agree.
about that?
I agree. It's just we hear from these operators how bad the media is painting this picture, but in all actuality, the operators that have the right precautions in place are doing the right things. It really hasn't
Correct.
affected much.
I also think some of the operators are doing some things to offset some of that risk. So if there is, mom or grandma goes in for hip surgery, the daughter is concerned about her going into a nursing home for 30 days for short-term rehab. I think that some of these operators are doing a great job of just implementing technology where the least amount of touches, the better. So you have some telehealth that are coming in, some monitors that are being hooked up to some of these patients that I think will reduce the number of touches and the number of touch points.
And even therapy within your own room, so they're not leaving there. Yeah, so there's a lot of different factors that come into play there. Neil, what about your workload through all of this? Has the demand for lending increased, decreased, stayed the same? What's your workload like?
So it's interesting. And I would say that that first month and a half, when it was mayhem, and I wasn't calling clients to ask them, oh, hey, do you have any new deals? Because they were in the middle of putting out fires, literally, at their facilities.
But Neil does deals.
Yeah, so I had to deal with that. But and now, thank God, I would say over the past month and a half, things picked up tremendously. I mean, on the HUD side, we've been very, very busy throughout, actually, because rates are at really, 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 really low. So people want to take advantage of that. But on the bridge side, over the past month and a half, 2 months, things really picked up, and there's a number of new transactions that we're working on. Thank God. How about you guys?
Yeah, I think your timing is really aligned with our timing. We saw a short-term pause, but we've really started to see things pick up as of late. And more, we expected a lot of sellers to come out of this and be ready to just kind of throw their arms up and say, okay, we're done. We're not really seeing too much of that. And you alluded to that earlier. We're not seeing the fire sales like some people had predicted. We're seeing more buy-side demand than we thought we would at this point.
Yeah, it was a seller's market before, and I think it still is.
I would agree with that, and I think that's good. I think that if there's tons of distressed facilities and these bankruptcy sales, that creates instability. I think that it's definitely more stable than I thought it would be. That's for sure.
Well, hey, before we wrap up, I do have a question, and that's more along the lines of I was asked this the other day, and I think I'd like to ask you as well, is when you get calls during the day or emails, what's the biggest concern that people have right now when they're talking to you?
I thought you were going to have a joke there.
No.
I thought you were setting up a joke. Okay.
Oh, okay. What is the biggest concern that people have? Execution right now. And that's just because that's my perspective of it. You're going to want to do a deal with a lender that's going to execute and then going to close on your deal. And in these times when there's a lot going on, you want to deal with a lender that has a track record and will get the deal done. Similar to what you alluded to with the press and all that. When you're dealing with a lender, sometimes it's a large institution, and there can be people at that institution that aren't as educated when it comes to healthcare. And if they're reading some big sensational story about how the future of healthcare is horrible, then it's going to give them pause. So you're going to want to be dealing with a lender that has been around, that knows healthcare, that knows the space well, that understands that there are ups and downs. That's very important, in my opinion. And clients also, for 10 basis points, they're not going with a lender that's not reliable.
Right. Yeah. Okay.
Well, Neil, I really appreciate you coming on the show. And how can people get in touch with you?
So you can email me at ngamss@hhcfinance.com. And I don't know if you're going to have any Sorry?
Gamss. We'll put that in the show notes, but 2 S's, right?
2 S's, yes.
Okay.
1 M, 2 S's. I don't know why. That's how we spell it. And then, or they could call me at 347-525-3663, which is my cell phone and my work phone. It's 1, and I'm reachable. I try to be reachable always. So
Great. We will have that in the show notes for anyone to get in touch with you or follow up with any questions. Neil, thanks so much.
Well,
for
thank you
being
so
on
much.
the
This
show.
was fun, and thank you for the opportunity.
Yeah, thank you.
Thank you. Take care.
Bye. Today, I want to talk about a skilled nursing facility that's available for sale in the Southeast. For those of you who like your sweet tea, you can head down to North Carolina. This opportunity is available in rural North Carolina. There are 60 plus beds available in this facility, and it's sitting at about a break-even EBITDAR. If you have any interest in this skilled nursing facility, you can contact me directly at brandon@senwelladvisors.com. That's brandon@senwelladvisors.com.
Thank you for listening to the Investment Opportunity Podcast. If you want to hear more about investing in the skilled nursing and seniors housing industry, head to our website at www.senwelladvisors.com/podcast.